Right now, something doesn't add up. Stocks are starting to crack, quietly. Not crashing yet, but weakening in a way most people aren't paying attention to. At the exact same time, Bitcoin is doing the opposite. It's holding, it's stabilizing, and according to Tom Lee and Michael Saylor, this could be the beginning of a massive shift. A shift where capital doesn't just rotate, it escapes. And here's the part nobody is ready for. This Bitcoin ramp might not wait for confirmation. By the time it's obvious, it's already too late. So the real question is, why is Bitcoin strengthening while everything else starts to weaken? And what do they see coming next?
Really appreciate you coming out to New Jersey, Michael. Thank you.
Happy to be here.
Okay, so the volatility, crypto has fallen over 50%, I think minimum of 10 times. If you are invested in crypto, you have to have a bit of a thick stomach, correct? Like, deal with volatility. The same thing has been true of your stock and your new stock, STRC. You call it Stretch. Are you trying to strip some of that volatility out with that equity?
Yeah, the idea is to create an on-ramp for people that believe that Bitcoin's going to be around for the long term, but they can't handle the volatility in the near term. So the idea of Bitcoin is you get on a roller coaster and you're expecting 30% or more, but you got to hold it for a decade. The idea of Stretch is we're going to strip the first 10 to 11% of that return. We're going to pass that to the credit investor. Our equity investors accept the excess volatility. They over-collateralize it. They get the excess performance. So STRC is a preferred stock that pays a monthly dividend. It's about 11.5% annualized right now. It's way over-collateralized. The bet of the company's strategy is Bitcoin will go up more than 11% a year, and our equity holders are going to make a fortune. And the bet that the credit investor is making is Bitcoin's a real legitimate thing, but I want to get paid 11% and ideally defer the taxes.
11% is a huge number as a dividend, effectively. You know there are people watching and listening right now that are saying they're using my initials BS in vain, bull, pucky, right? How is 11% possible? That is a big number.
Okay, Bitcoin's up about 37% a year for the past 5 years. That's the slowest it's ever grown. Our company's strategy is up about 55%. We've levered that Bitcoin. The bet is Bitcoin is going to outperform the 11% over the next decade. Now, if Bitcoin outperforms the 11%, then our company equity is making a lot of money. If Bitcoin performs if it's up 2% a year, all it needs to be is 2% a year, we can pay those dividends forever, Brian. And if Bitcoin...
If just up 2%.
Because we're sitting on a mountain of equity. We're sitting on more than $50 billion of Bitcoin as collateral. So Bitcoin only needs to go up 2% a year for us to pay the dividends forever. The equity, MSTR, wouldn't make as much money, but the credit's fine. If Bitcoin goes up 0% a year, then in 50 years, we got to figure something out.
So private credit has been two bad words lately. You know that, right? You look at Ares, KKR, Blue Owl, Apollo, some of these funds, private credit, all the cracks, blah, blah, blah. Does your then private digital credit, I think is a fair way to say it, does that run alongside private credit, or is it meant to supplant private credit?
If you're the investor that you want a credit instrument that pays you double-digit yields, normally you had to go after something like private credit, but the price you paid was illiquidity. It's not liquid, and it's...
They have your money, you can't do it. You give it to me back.
Genius. It's like 1,000 different investments. It's illiquid, and they're going to lever it a bit to try to give you a 8% or 9 or 10% return. What we've done is taken the world's most liquid asset, Bitcoin, which is global capital, very volatile, and then we built a credit instrument where the idea is let's make it extremely liquid, let's make it double-digit return, let's make it homogeneous. The credit, the underlying collateral of STRC is Bitcoin itself. So you can assess the credit risk of STRC every 15 seconds by looking at the price of Bitcoin.
Tom Lee is essentially telling a story most investors are too emotional to see clearly in real time. While headlines scream crisis, war, volatility, uncertainty, markets are already doing something quietly beneath the surface. They're adapting faster than people think. History shows that even during massive conflicts like World War II, markets don't wait for the war to end. They price in the fear early, then begin recovering long before clarity arrives. Right now, he believes we're deep in that psychological trap. Investors who panicked and moved to cash are stuck, watching the market hover just below where they sold, unsure whether to jump back in or miss the recovery. But here's the tension. The market is like a compressed spring. If even a hint of resolution appears, especially around geopolitical tensions, it could snap back violently upward. In Lee's view, the fear phase is nearly over, and the opportunity phase is quietly beginning.
March came in like a bear, stayed like a bear for, I think it came in about 6,900 on the S&P. We got 6,350 or so, and then a bounce. Last week we're back to 6,580. Your call, I think, like so many of your calls, there's some volatility near term, but then a successful resolution by the end of it. That didn't quite happen in March. I think maybe things are taking longer than you thought for the war, but you're kind of just pushing it back a month, are you not?
Yeah. As March unfolded, the war looked like not to be a short war, but, one that was longer. And I think markets have been adjusting to that. But as you know, we're still in the midst of this fog of war because we don't know when it ends. But we did look at the past 7 major war events. And the stock market adjusts pretty quickly. Within the first 10% of the entire duration of a war, the stock market usually bottoms. So, World War II was almost 5 years, and the market bottomed 5 months into that war. So I do think, as bad as March was, we've probably seen a big part of that adjustment. And now I think the risk reward is quite good for stocks.
And 90 to 95% of the weakness is behind us, in your view.
Yes. And I think people are kind of torn because if someone sold in March and the market, they may have sold 3 or 4% off the highs, and we're just 5% off the highs, they've got a dilemma because the market's only a little bit lower than where they might have sold, but it wouldn't take a lot for the markets to begin to recover. So I do think investors who've gone to cash really have to start to think about how war, as much as it's a crisis, people focus on the negatives initially, but then they need to start thinking about the opportunity on the other side.
We talked about the false start in oil when it sold off. There was also a day where we were down 200 or 300 points. Trump said something and we were up 1,300 points. So is it spring loaded right now, but wary? It's like, I think everybody's like, well, yeah, we've seen this before. We're going to need more real evidence before it makes a move again like that. But what kind of move would it make if there was a definitive agreement that Iran even admitted to? Because they haven't admitted to anything yet, but that's their playbook.
Yeah, I mean...
You think spring loaded?
Really spring loaded because, one, we know that policy and the path of the war is more important than the central bank. So that's the single biggest driver of the stock market. The stock market's getting a bit of a boost from all the defense spending. So the economy is not in horrible shape.
Oil stocks are doing pretty well, too.
Yeah, oil stocks are doing well. But then if there's Middle East peace, of course, that's got a lot of future benefits. So I think if there is a surprise and the war does end, the reaction would be very explosive, as you said.
I just want to read you what, and we're talking about, Leslie was talking about earlier. This is the Jamie Dimon letter. Mostly bullish, but then makes this point at the end, sort of one section, where he says the skunk at the party, and it could happen in 2026, which is now, would be inflation slowly going up as opposed to slowly going down. This alone could cause interest rates to rise, asset prices to drop. This would make Kevin Warsh's life a lot more difficult. And interest rates are like gravity to almost all asset prices. And falling asset prices at one point can change sentiment rapidly and cause a flight to cash. Your reaction to that?
Well,
and that's, by the way, his downside scenario. I mean, that's sort of how he's laying it out.
I think that's everyone's concern because we've had several inflation shocks now in the last 6 years, right? The first was the COVID supply chain, and then was the tariff shock, and then this is a war shock that's going through. And nobody wants consumers to suddenly expect higher prices. So I think that's what everybody is watching carefully. But it doesn't mean that just because prices are going up because of this, of gasoline, that inflation expectations are unanchored. So I do think right now it's a critical time for the Fed to have credibility and for consumers not to expect higher prices going forward. Investors need to keep in mind that wartime spending is, $30 billion and maybe going up to $100 billion a month of economic stimulus, and that does boost the economy. Gasoline, every $10 is about $4 billion to $5 billion a month hit to the consumer. So the monthly spend from the war is much higher than the effect from oil.
Yeah, that is a cynical viewpoint about war.
Yeah.
Forever about war, about how.
Is that why you are not as worried about inflation sticking in there for the longer term?
It's if this is a shorter war and the oil curve doesn't seem to expect it to be into year end, then it's an inflation shock, not a inflation
but
episode.
You don't think the Fed's going to be cutting rates anytime soon if it's not worried about the jobs picture?
No, it wouldn't make sense in the near term. I think market expectations are correct.
Crypto's fine. You're not, yeah.
Well, after energy stocks, which have done well since the war started, the second best performing asset is Ethereum, and the third best is Bitcoin. They've both been up on an absolute basis and beating the equity market.